Hi, my name is Paddy Hirsch. I'm a senior editor at Marketplace, and today I want to talk about tangible common equity, or TCE. We've had a lot of calls and a lot of letters written in about this because people are interested in what the TCE and the TCE ratio is, because it's really the linchpin or the main reason behind the government's decision to convert a bunch of its preferred shares in Citigroup into common shares and turn the US taxpayer into an equity holder in a bank. So let's give it a shot to see if we can explain it. It's tangible common equity. Tangible because you can touch it. Common equity because we're talking about common stock. Whoops. Equity. Oh dear. I can't even spell TCE. All right, so it's TCE is the abbreviation. Now, tangible common equity is it's an accounting term. And it's an extremely conservative view of a company. So let's look at it with regard to a bank, and we'll make our little bank up here. Here we have the bank, and it's the bank of four guys. Okay, oops, it's the four guys bank. And the reason is because these four guys have gotten together, and they've all put $1 in, and they've decided to start this bank. So let's have a look at this bank's balance sheet. Here it is. Okay, that's just like every good bank, it balances. The first thing that goes on the balance sheet is the money that these guys put in. Okay, so that's the initial equity. Initial equity, for short, and that's the $4. Okay, so the bank starts doing business, it brings money in, it borrows money at one rate, lends it at a higher rate, and makes money off that. So this is on the equity side here, is this initial equity that they put in, and those loans that we're talking about that they borrow from other organizations, those are liabilities. Okay? This is kind of ABC of the balance sheet here. So on the liability side, we have, say, $100 in loans. So we'll call these borrowings. Okay? And we've got $100 in borrowings there. All right? That takes those borrowings, turns them into loans, and lends them out to other people. And those go on the asset side. Okay? And so we've got loans to the tune of $100. Okay, what else have we got in this bank? Well, as the bank takes money in and lends it out, it's going to be making money all the time, and it does various things with that money. The first thing it might do is it might put money into its little pot here so as to swell the equity. So this cash goes in here. So it's put cash under the equity side. So we've got $1 there. Those are what's called retained earnings. The second thing it might do, it might go out and it might buy some stock and some bonds. So let's say we get some stock in there. So we get $2 in stock. Might go out and buy some bonds from somebody else. Another $2 in bonds. Okay. What else might it do? Well, it might keep some cash on some cash there, or buy cash equivalents like treasuries. Let's call that cash. We've got $1 there. What else have we got? Well, it may have bought some other companies, and probably because the economy was growing, estimated them at higher than the market value and paid more than that. That's called goodwill. So that goes on the sheet as well. Goodwill. And say we got $45 in goodwill. In order to make that acquisition, they needed to get some money from somewhere, so they went out and they tapped some other shareholders called preferred shareholders. Now, preferred shares are slightly different from common shares. They go in the equity portion of the balance sheet, but they look a lot like debt. They sound like equity, but they look a lot like debt because it's not like a loan where they're going to get the money back. What they get is a dividend every month, and so the bank has to pay those shareholders a dividend every month. Now, in the case of convertible preferred shares, which is a type of preferred shares, the bank or the shareholder has the right to convert its preferred shares into common shares at some point in the future. We'll get to that in a second. Anyway, so here we have a preferred shared investment, preferred, and this is around $45. Okay, so the accountants come and they decide that they want to work out what the tangible common equity of this company is. What is the tangible common equity of the bank? And it's kind of like taking a lemon, squeezing it, and getting the juice out. All right, the rest of it you kind of toss away, or the rest of it you discount. So you're really interested in the juice that's going to come out that the shareholders can divide amongst themselves. So what's in this? What's the TCE for this bank? Let's go down the list. Firstly, what about these loans? Yep, those loans, you could certainly sell them, you'd make $100. Unfortunately, you've borrowed $100 as well, so your borrowings cancel out your loans. All right, so those would go in, but they've been cancelled out. What about this stock? Yep, you can sell the stock. So stock goes down, $2. What about these bonds? Yep, you can totally sell the bonds, make $2 out of them. Bonds, $2. What about this cash that they're holding? Absolutely, cash goes on the sheet. Okay, there's $1 there. What about this goodwill? Goodwill is what's called an intangible. Okay, when these accountants look and are trying to get the tangible common equity, they're going to discount an intangible. It's something that's much more difficult to put a value on. So goodwill doesn't make the cut. Trouble on the other side of the balance sheet. What about this initial equity that they have? This $4. Yep, absolutely. So the equity goes in, $4. What about this cash that they have? The retained earnings. Yep, that certainly works out. They'll keep the cash, so more cash there. That's $1 there. What about this preferred equity here? No, preferred equity isn't going to make the cut. The accountants who are looking at the tangible common equity say to themselves, preferred, you have to, the bank is required to pay out a dividend every month. It kind of looks more like a liability. It doesn't make the cut for tangible common equity, so it doesn't go on the TCE list. Okay, so let's add all this up, see what we've got. 2, 4, 5, 6, and so we've got $10 altogether. All right, so our tangible common equity of this bank is $10. All right, so what's the tangible common equity ratio? Well, the ratio shows us the leverage of the bank. Leverage meaning how much you've borrowed. And we know from bitter experience that if you borrow too much in a bad economy, you're going to run into trouble. If you borrow too much anyway, you have the potential to run into trouble. So the higher your leverage, the greater your risk. And you do that, you ascertain this by dividing your TCE number by the amount of borrowings that you have, by the loans that you have. So here we have TCE, $10, divided by 100, and the TCE is going to be 10%. All right. Now, say it was $150. Say we made that more than that. So $150, it would be 6.6%. So clearly, the more borrowings that you have, the higher leverage that you have, the lower your TCE ratio goes. Okay. Now, in the case of Citibank, all right, Citi TCE, all right, Citi TCE ratio was a stunning 1.9%, so really low, which means its leverage was really, really high. Okay, and that's particularly high given the average TCE ratio of banks prior to the crisis was of the top 20 banks was between 3 and 5%. So how are we going to get this TCE ratio up towards 5%? Well, the best way to do it is to deal with the TCE, make the TCE larger, because if you keep the same number of loans and you have a higher TCE, it means that your ratio is going to go up. All right. So how do you make this number larger? How do you make this nut larger? Well, the solution that they hit on, well, you could do more business, of course, bring more money in, but in order to do that or to acquire more assets, you need to make more money. That means you need to make more loans. That means you need to borrow more loans. So it's kind of a wash. So what they decided to do was to look at this preferred equity. All right. In this case, this $45 here. Now, because of the preferred equity, what you can do is those preferred shareholders can convert into common stock. And what that does is it drives the number of the conversion down into the TCE. All right. So in the case of Citigroup, we had the government basically made two investments in October and November of last year, one of $25 billion and the other of $20 billion. And it took that $25 billion and it converted it into common stock. And that meant that the government took a common stock share, all right? It became one of these shareholders in the bank, but it also increased the size of the TCE by $25 billion, okay? So you think of Citigroup's TCE, it's suddenly grown by $25 billion, you divide it by the same number of loans, that TCE ratio is going to go up. And that's all that this was about, was trying to drive up that TCE ratio and therefore, retain the solvency of the banks, or of this particular bank. So, Citigroup's really happy, all right? Its TCE grows, its TCE ratio swells, it's got less leverage, and best of all, it now is only paying its dividends on $20 billion of preferred stock as opposed to 45. So its monthly payments go down, and its leverage ratio goes up. So it's healthier in a number of ways. Now, what do the shareholders think? Well, now, when Citigroup made this investment, okay, when the government made this investment in Citigroup and made this conversion, it got 36% of the bank. Okay, now that means that the existing shareholders of Citigroup have now been sort of crammed down. They've been kind of forced into the side of the capital structure by the government to sort of come in with this enormous number of new shares. So the original shareholders of Citigroup, who used to own 100% of the bank, now own significantly less. And once the government has received its common stock and made that conversion, and a number of other organizations also go and make these conversions, and there are several others, not just the US government, it means that the Citigroup shareholders, which used to own 100%, now own between 25 and 26%. So they've been diluted by 3/4. So they're really not happy because their piece of the pie is a lot smaller than it used to be. Not happy at all. The other people that aren't particularly happy or might not be particularly happy about this is the US taxpayer. Why? Well, for this 36%, okay, we paid per share $3.25. I say we, I mean the US government. So that conversion was made at $3.25 a share. Now let me tell you one thing. We have already paid this money. The US taxpayer paid this money into Citigroup in October and November of last year. So that $45 billion has already been paid. So this $25 billion injection into the TCE is not new money. We're not paying new money, all right? It was already there. It's just been shifted from one part of the capital structure to another. So right now, we don't have to worry about paying any more money. We may have to in the future, but right now we don't. But the issue is that we paid $3.25 on a day when Citigroup was actually trading at $1.50. So we paid double the price of shares when we made that, when the government made that transaction. More than double the price it paid up for that. So that's kind of like the government going to that guy down the road from you, you know, the deadbeat guy who bought a house that was way too large and was way more than he could afford, and he used the liar loan, and the interest rates jumped up, and he can't pay his mortgage, and he's way underwater because the market's dropped away. That guy. It's like the government going to him and saying, look, I know your house is only worth $150,000, but I'm going to pay you $325,000 for it. I mean, why would the government want to do a deal like that? Well, in Citigroup's case, the government wants to do it because number one priority is to save Citigroup. Okay, if Citigroup goes down, then the government is worried about systemic failure. Citigroup goes down, maybe Bank of America goes down, maybe a number of the other big banks in the US go down, and then there's a ripple effect right the way through our economy, through the European economy, through the Asian economy. So we're worried about systemic failure of the banks, and that's what the government is trying to forestall by taking a large stake, by increasing the size of this TCE, but without nationalizing, by keeping it under 50%, so keeping it to 36%. So that's one reason. The second reason, of course, that the government thinks that, you know, Citigroup has been a good operator over time. It's, you know, used to be worth a great deal of money. Maybe it will be great again, and maybe these shares will trade above $3.25. Maybe they'll go to $5 a share, and then our 36% of stake will be worth rather a lot, and we can sell it and you know, make money on this deal. Of course, this being the market, could also go the other way, okay? And indeed, the day after, or the Monday after the transaction was announced, you know, Citigroup's shares went to $1.40 a share. They could go lower than $1.40. They could go to $1. They could go all the way to zero. And if that happens, then everybody, Citigroup, the government, and you and I, the taxpayer, are going to be left very badly needing a drink.